Every generation learns the same lesson. In 1929, the market fell 89%. Millions lost everything. Breadlines stretched for blocks. In 1987, the market dropped 22% in a single day, the largest one-day collapse in history. In 2008, the global financial system came within hours of complete seizure. Banks that had stood for 150 years vanished overnight. And yet, the same names, the same firms, the same families. They didn't just survive, they made fortunes. Not by luck, not by chance, by pattern. A four-stage pattern so precise, so repeatable, that it's been executed across a century of crashes. The same playbook, the same timeline, the same outcome, and if you know what to look for, you can see it happening again. Right now. The four-stage pattern. Here's what they don't teach you in economics class. Market crashes aren't natural disasters. They're not earthquakes or hurricanes. They're engineered events with predictable structures, and the people who understand that structure don't fear crashes. They wait for them, because there's a pattern, 4 stages, executed with precision across 1929, 1987, 2008, and what's coming next. Stage 1. Exit. 12 to 18 months before the crash, they begin moving capital out of risk assets, quietly, methodically, while the public is still celebrating record highs. Stage 2. Insurance. 6 to 12 months out, they buy volatility protection, puts, VIX calls, credit default swaps, instruments that explode in value when markets panic. Stage 3. Short. 3 to 6 months before, they take targeted short positions, not the whole market, specific sectors they know will collapse first. Stage 4. Buy. When fear reaches its peak, when everyone else is selling, when blood is in the streets, they buy everything at generational lows. This isn't conspiracy theory. This is documented history. Let me show you. Stage 1. Exit. 12 to 18 months before 1929. Joseph Kennedy, August 1928. The market is roaring. Everyone's getting rich. Shoeshine boys are giving stock tips. Joseph Kennedy, bootlegger, speculator, future patriarch, is having lunch on Wall Street. His shoeshine boy starts talking about his portfolio. Kennedy doesn't finish his meal. He goes straight to his broker. Sell everything. His associates think he's insane. The market has doubled in 3 years. Why would you exit now? Kennedy knows something they don't. When everyone's in, there's no one left to buy. He liquidates his entire position, 14 months before Black Tuesday, October 1929. The market loses 89% of its value over 3 years. Kennedy's wealth? Intact. Actually multiplied, because he was liquid when everyone else was trapped. 1987. George Soros, spring 1986. The Dow has climbed 40% in 18 months. Paul Volcker's rate cuts have ignited a speculative frenzy. George Soros, running the Quantum Fund, begins trimming equity exposure, not all at once, not dramatically, just reducing, rotating into bonds, building cash positions. His analysts question him. The bull market has years left, they say. Soros shrugs. Trees don't grow to the sky. By summer 1987, 4 months before Black Monday, he's 30% cash. His fund is underperforming. Investors are grumbling. October 19th, 1987. The Dow drops 22.6% in 6 hours. The Quantum Fund, down only 3% for the month, while competitors lose everything. 2008, John Paulson housing prices have never been higher. Subprime mortgages are being packaged and sold as AAA-rated bonds. John Paulson, running a $4 billion fund, starts liquidating real estate positions. His team spends months analyzing mortgage data, default rates, FICO scores, the underwriting standards behind those AAA ratings. What they find is terrifying. The entire system is built on loans that will never be repaid. By early 2007, 18 months before Lehman, Paulson's fund is out of real estate entirely. His investors revolt. He's missing the boom. Fire him, they demand. September 2008. Lehman Brothers collapses. The S&P 500 loses 57% of its value. Paulson's fund? Up 590%. The greatest trade in history. The pattern. See it? They all exited early. Not at the top, before the top. While everyone else was euphoric, they were walking toward the exit. They weren't lucky. They understood the cycle. And they knew, to profit from the crash, you first have to survive it. Stage 2. Buy volatility insurance 6 to 12 months before. Exiting early keeps your capital safe. But insurance? That's how you get paid when the world ends. 1987. The put explosion. Early 1987. A few institutional desks start buying out-of-the-money put options on the S&P 500. Puts are bets that the market will fall. They're cheap when markets are calm. Pennies on the dollar. In January 1987, you could buy 6-month puts 15% below market for almost nothing. By October, those puts were worth 50 times their purchase price. Who bought them? Renaissance Technologies, D.E. Shaw, a handful of quant shops that understood volatility pricing. They didn't predict the crash, they didn't need to, they just knew. Insurance is cheapest before the fire starts. 2007, the greatest short. John Paulson didn't just exit real estate in 2006, he bought insurance, mountains of it. Specifically, credit default swaps on subprime mortgage bonds. A CDS is a bet that a bond will fail. In 2006, you could buy protection on AAA-rated mortgage bonds for 0.12% annually, meaning for every $1 million in bonds, you paid $1,200 per year to insure them. If those bonds defaulted, you got paid $1 million. Paulson spent $1 billion buying CDS protection across 2006 to 2007. When the bonds failed in 2008, he collected $15 billion. The greatest asymmetric trade in history. Risk $1 billion to make $15 billion. 2025, the VIX position. Right now, today, a handful of institutional players are building massive VIX call positions. The VIX measures volatility, fear. When markets panic, the VIX spikes. In calm markets, VIX calls are dirt cheap. When volatility explodes, they can return 10 times, 50 times, even 100 times. In December 2024, VIX calls 6 months out were trading at historic lows. Certain funds, Universa, Criscat, a few others, have been accumulating them for months. They're not predicting a crash. They're insuring against one. And when it comes, they'll be the only ones holding paper that's worth more, not less. The pattern. Volatility insurance has the same profile every time. Bought when markets are calm, costs almost nothing. Pays exponentially when panic hits. It's not gambling. It's asymmetry. Risk a little, gain a lot. The weapon of those who see what's coming. Stage 3. Short specific sectors. 3 to 6 months before. Now we're in the end game. Capital is safe. Insurance is in place. Stage 3 is where you go offensive. 1929. Bernard Baruch. Bernard Baruch was a Wall Street legend, advisor to presidents, speculator, strategist. In March 1929, 7 months before the crash, he began shorting overextended sectors. Not the whole market, specific targets, utility holding companies, overleveraged pyramids, margin-fueled retail brokerages, speculative trusts trading at 3 times book value. He borrowed shares, sold them, and waited for the collapse. October 1929, utilities fell 90%, brokerages vanished, trusts went to zero. Baruch covered his shorts and walked away with $20 million, about $350 million today. 1987, the program trading collapse. By mid-1987, a handful of sharp traders noticed something dangerous. Portfolio insurance. Institutions were using computer algorithms to automatically sell stocks if prices fell. The idea was to limit losses. The problem? If everyone's algorithm sells at once, prices collapse faster. It's a feedback loop, a doom spiral. Certain hedge funds, Tiger Management, Steinhardt Partners, began shorting index futures 3 months before the crash. They weren't betting on a crash. They were betting on the structure. Automated selling would amplify any decline. October 19th. Their shorts paid off as program trading created the fastest collapse in market history. 2008. Shorting the banks, Michael Burry, Steve Eisman, Kyle Bass. They didn't just short mortgage bonds. They shorted the banks holding those bonds. Why? Because once the bonds failed, the banks would be insolvent. Lehman, Bear Stearns, Merrill Lynch, Wachovia. These firms had balance sheets packed with toxic subprime debt. The shorts began in early 2008, 6 months before Lehman collapsed. By September, those positions had returned 300%, 500%, in some cases 1,000%. 2025. The targets. If you're paying attention right now, you can see the setup. The sectors being shorted today, regional banks, loaded with underwater commercial real estate loans, zombie tech companies, unprofitable firms surviving on cheap debt-leveraged retail, consumer discretionary companies facing collapsing demand. These aren't random bets. They're structural vulnerabilities, the same playbook, the same timeline, and the people who understand this, they're already positioned. The pattern. The smartest shorts aren't market-wide. They're surgical. Target the weakest link, the most overleveraged, the most exposed, then wait for the system to break exactly where you predicted. Stage 4. Buy at maximum fear. This is where fortunes are made, not in the crash, in the recovery, but only if you have capital left when everyone else is bankrupt. 1932. The Rothschild Rule. There's an old saying, attributed to Baron Rothschild in the 19th century, the time to buy is when there's blood in the streets. By 1932, there was blood everywhere. The Dow had fallen from 381 to 41, an 89% collapse. Banks had failed. Unemployment hit 25%. The economy was in ruins. And that's when the Rockefellers, the Mellons, the Morgans, they started buying. Not at the bottom. They didn't try to time it perfectly. They bought when fear was maximum, when no one else could buy. Shares of U.S. Steel, $5. General Electric, $8. DuPont, $22. By 1954, those positions had returned 30 times, 50 times, in some cases 100 times. 1988. The rebound. October. 1987. The Dow loses 22.6% in a day. Everyone panics. Retail investors flee. Mutual funds see record redemptions. George Soros? He buys. Not the day of the crash. Not even that week. He waits until late November, when the fear is still thick, when everyone's still traumatized. Then he deploys the cash he'd been holding since spring. By December 1988, the market is back to pre-crash levels. Soros's fund, up 40% for the year. 2009, the generational buy. March 2009, the S&P 500 has fallen to 666. The financial system nearly collapsed. Lehman is gone. AIG was bailed out. GM is bankrupt. No one wants to buy stocks. It feels like the end of capitalism. Warren Buffett writes an op-ed, "Buy American, I am." He deploys $15 billion into Bank of America, Goldman Sachs, General Electric. Billionaires who'd been sitting in cash, Tepper, Dalio, Griffin, they all buy. Not because they think the bottom is in, because they know, when everyone's terrified, assets are cheap. By 2012, the S&P has doubled. By 2020, it's up 400%. Those who bought in March 2009 made generational wealth. 2025, the next window. Right now, we're in stage 1 or stage 2. Markets are still near all-time highs. Fear is low, but the cracks are forming. Regional banks under stress, commercial real estate defaults rising, consumer debt at record levels, corporate bankruptcies accelerating. When the crash comes, and it will, most people will sell in panic. They'll lock in losses, they'll swear off stocks forever, and a small group, the ones who understand the pattern, will buy everything. Not because they're smarter, because they were prepared. The pattern. The fourth stage isn't about prediction, it's about position. If you're liquid when everyone else is leveraged, if you're calm when everyone else is panicking, if you're buying when everyone else is selling, you don't need to time the bottom perfectly. You just need to act when no one else can. What you can do. So what does this mean for you? You're not Joseph Kennedy. You're not George Soros. You don't manage a billion-dollar fund, but the pattern still applies. Here's what you can do. 1. Understand where we are. Watch for the signs. Euphoria. Record highs. This time is different. Leverage expanding, margin debt rising, speculation everywhere, insiders selling, CEOs liquidating stock, institutions rotating. When you see these, we're in the late stage. 2. Build cash positions. You don't need to time the exit perfectly, but if markets are at all-time highs, if valuations are stretched, if leverage is extreme, start moving toward the exit, not all at once, but gradually, methodically. The goal isn't to maximize gains in the final manic phase. The goal is to have capital when the crash comes. 3. Consider volatility protection. You can't buy credit default swaps. You're not John Paulson, but you can buy out-of-the-money puts on major indices, VIX call options, inverse ETFs. Carefully, they decay over time. These are insurance. They cost money. Most of the time, they'll expire worthless. But when the crash comes, they'll be the only thing in your portfolio that's green. 4. Identify weak sectors. You don't need insider information. Just look for structural vulnerabilities. Which sectors are most leveraged? Which companies are unprofitable and dependent on cheap debt? Which industries face systemic risk? You don't need to short them. Shorting is risky and complex, but you can avoid them. And when the crash comes, you'll be glad you did. 5. Prepare to buy. This is the hardest part. When the crash happens, every instinct will tell you to sell. The news will be catastrophic. Friends will be panicking. Your portfolio will be bleeding. That's when you need to buy. Not all your cash, not all at once, but methodically, scaling in, buying quality assets at fire sale prices. The people who bought in 1932, 1988, 2009, they're the ones who built generational wealth. Not because they were fearless, because they were prepared. Final revelation. Here's the truth they don't want you to understand. The system isn't broken. It's working exactly as designed. Crashes aren't bugs, they're features. They're the mechanism by which wealth is transferred from the unprepared to the prepared, from the emotional to the strategic, from the many to the few. Every generation, the same pattern repeats. Markets boom. Euphoria builds. Everyone gets rich. The insiders exit. They buy insurance. They take short positions. The crash comes. Panic, liquidation, ruin. The insiders buy everything at the bottom. Generational wealth is made. And soon, maybe this year, maybe next, it will happen again. Not because of manipulation, not because of conspiracy, because the pattern is built into the structure of the system itself. Leverage creates fragility, euphoria creates complacency, panic creates opportunity. The people who understand this don't fear crashes, they prepare for them. And when the crash comes, they don't lose, they win. So the question isn't, will there be another crash? The question is, when it comes, which side will you be on? Will you be the one selling in panic, locking in losses, swearing off markets forever? Or will you be the one with cash, with insurance, with a plan, buying everything while it's on sale? The pattern repeats. It always has. It always will. The only question is whether you'll recognize it in time.